A US software company enters the quarter with a simple margin decision. Its flagship AI assistant is growing quickly and reports the portfolio's strongest gross margin. A smaller workflow product shows slower growth, heavier support demands, and weaker economics. Before a quarterly board review, management removes the weaker offer and backs the apparent winner. The next quarter, the flagship still grows, yet its margin narrows. Infrastructure expense is reassigned. Renewal discounts become harder to absorb. Customer acquisition costs rise because the retired product had opened larger accounts. A product that seemed to dilute profitability had been carrying functions the stronger product relied on. The margin existed. Its ownership was misread. This is the central problem in cross-subsidization. One product or segment reports the profit, while another absorbs part of the cost required to create it. AI intensifies this because shared models, infrastructure, and teams support several offers at once. Picture three boxes: Product A, Product B, shared AI platform. Revenue enters through the first two. Most fixed burden sits in the third. The error begins when management asks which product is profitable without asking how much platform capacity each consumes, what demand each creates, and which customers remain if one box disappears. The portfolio can look balanced while the transfer is unstable. Cross-subsidization can recover fixed commitments and support market entry. A lower-priced AI feature may attract users, while a premium tier funds security, integration, support, and model operations. The structure holds only if the subsidizing revenue stream carries those commitments through renewals, discounts, and changing usage. Accounting allocation and economic contribution are not the same. Shared infrastructure is often assigned by revenue share, usage, headcount, or departmental ownership. Those methods may satisfy reporting while misrepresenting dependency. One customer may use little inference but require extensive integration. Another may consume more compute yet support durable subscription revenue. Reported margin can change without the business changing at all. But the distortion does not remain inside management reporting. It enters the customer contract. In US enterprise markets, pricing is shaped by procurement pressure, competitive benchmarks, quarter-end targets, and account relationships. A company may price an AI module aggressively, then recover the shortfall through implementation fees, premium support, longer contracts, or adjacent software. The low price does not prove low cost. It may reveal a different recovery path. This structure works while the bundle remains intact. Once buyers negotiate each component separately, the transfer becomes visible. Procurement may demand the low AI price without the services that financed it. Competitors may copy the feature without the same legacy burden. The portfolio can fail when each component must stand alone. Volume may increase while fixed cost recovery weakens. Cross-subsidization is not primarily a discounting tactic. It is a decision about which revenue stream must recover a shared commitment. That decision may be deliberate, temporary, or accidental. Its stability depends on whether the chosen source has enough margin, durability, and contractual protection. The direction of subsidy can also reverse. Early in adoption, established products often finance new AI capabilities. Existing subscriptions absorb model expense, integration work, and pilot support. Later, if the AI layer becomes central to retention, the relationship can flip. The AI product protects the legacy base, while the older product becomes its distribution channel. The older product stops financing the AI layer and begins distributing it. AI therefore changes which revenue stream is expected to carry the shared platform. An aggressively priced feature may look efficient because premium contracts, implementation revenue, or legacy subscriptions absorb the commitments behind it. The reported margin reflects the chosen recovery path, not the complete economics of the capability. That is where clean reporting can conceal fragile economics. A sustainable strategy tests what happens when the subsidy is interrupted. If the premium tier slows, can the entry product fund its infrastructure? If implementation revenue falls, does the subscription remain profitable after support is assigned? If a legacy product is retired, does retention weaken? If a low-priced AI feature becomes standard, where will fixed cost recovery move next? These questions separate intentional portfolio design from accidental dependency. Quarterly pressure favors the simplest story. Remove the weak product, protect the strong product, and concentrate capital. But simplification can destroy hidden links faster than it removes cost. Infrastructure, sales coverage, support capacity, and enterprise obligations may remain after the supporting revenue is gone. What looked removable may still be structurally embedded. The correct evaluation unit is not always the product. It may be the account, bundle, platform, or portfolio. A weak standalone margin can still matter if the product lowers acquisition cost, raises utilization, strengthens retention, or preserves pricing power. But that contribution must be measured. Otherwise, almost any weak product can be defended as strategically necessary. Cross-subsidization requires evidence, not narrative. Return to the three-box sketch, but redraw the recovery paths. Product A may generate the most revenue. Product B may create the account relationship. The shared AI platform may carry the largest fixed commitment. A durable structure identifies which arrow funds, which burden, and what remains if one box is removed. Without that view, margin reporting describes where profit is recorded, not what produced it. Cross-subsidization can accelerate adoption and recover shared AI investment. It can also hide weak pricing and portfolio dependence. The strategy remains stable only while the funding source sustains the transfer, customers accept the bundle, and competitors cannot isolate the underpriced component. The margin may be booked in one product. The economic support often comes from the system around it. Understanding that durable pricing is self-supporting. Borrowed profitability always depends on something else.